whole housing market is propped up on these bad loans. They will fail.
Imagine you have $1.6 billion to invest in the stock market. What would you do? Would you buy shares for the most popular and profitable companies, hoping to ride the wave of the bull market? Or would you bet against the entire market, expecting a crash that would wipe out trillions of dollars in value? Today, we will explore why Micheal Burry is making a huge bet against the 2024 stock market. Micheal Burry is the founder and head of Scion Asset Management, a hedge fund that specializes in value investing and contrarian strategies. He rose to fame after he was featured in the book and movie The Big Short, which chronicled his successful bet against the subprime mortgage market in the mid-2000s. Burry made a fortune by buying credit default swaps, which are essentially insurance contracts that pay off if a borrower defaults on a loan. He saw that the housing market was built on a bubble of risky loans that were bound to burst, and he profited from the ensuing crash. But Burry is not resting on his laurels. He is always looking for the next big opportunity, even if it means going against the crowd. In August 2023, he revealed that he bought put options on 2 exchange-traded funds that track the performance of the S&P 500 and the Nasdaq 100, the 2 most widely followed stock market indices in the US. Put options are contracts that give the buyer the right, but not the obligation, to sell an asset at a specified price before a certain date. They are used to hedge against a decline in the value of the underlying asset or to speculate on a drop in the price. Burry's put options have a notional value of $1.6 billion, meaning that he stands to gain a lot if the stock market crashes and lose a lot if it doesn't. There are several possible reasons why Micheal Burry, the famous investor who predicted the subprime mortgage crisis of 2008, is so bearish in the stock market and expects a crash in 2024. Here are some of the most prominent ones. The COVID-19 pandemic has caused unprecedented disruption to the global economy, health, and society. It has prompted massive fiscal and monetary stimulus from the governments and central banks, which have injected trillions of dollars into the financial systems to support businesses and consumers. While this has helped to cushion the impact of the pandemic and fuel a recovery in the stock market, it has also created some side effects, such as inflation, debt, and asset bubbles. The world is becoming more divided and unstable as the US and China compete for global influence and leadership, and as other countries face their own political and social issues. The US-China trade war that began in 2018 has grown into a broader conflict involving technology, security, human rights, and diplomacy. This relationship has a significant impact on the global economy and stock market. Any escalation of tensions or other geopolitical risks could cause a major market shock. The stock market has been on a tear since the pandemic-induced crash in March 2020, reaching new record highs in late 2020 and early 2021. A combination of factors such as the stimulus measures, the low interest rates, the vaccine optimism, earnings growth, and investor sentiment has driven the market rally. However, some analysts and investors have warned that the market has become overvalued, overbought, and overconfident, and that some sectors and stocks have entered a bubble territory. The stock market is trading at historically high levels of valuation based on various metrics, such as the price-to-earnings ratio, the price-to-sales ratio, the market capitalization to GDP ratio, and the Buffett indicator. These metrics measure how expensive the stock market is relative to its earnings, sales, economic output, and corporate net worth. According to these metrics, the stock market is more overvalued than it was before the dot-com bubble burst in 2000 and before the financial crisis in 2008. The stock market has been remarkably calm and resilient despite the pandemic and other uncertainties. The Volatility Index, or VIX, which measures the expected volatility of the S&P 500, has fallen from its peak of 82 69 in March 2020 to around 20 in January 2021, which is below the long-term average of 25. A low VIX indicates that investors are complacent and confident that they are not pricing in the risks and uncertainties. However, a low VIX can also be a sign of a bubble, as it indicates that investors are ignoring the warning signs and are chasing returns without regard to the fundamentals. A low VIX can also precede a spike in volatility, as it did before the crashes in 2000 and 2008. The stock market has witnessed a surge in speculative activity, especially among retail investors who have easy access to trading platforms, low-cost or zero-commission brokers, stimulus checks, and social media influence. Retail investors have been buying stocks of companies that are unprofitable, bankrupt, or excited, hoping to make a quick profit. They have also been using options, margin, and leverage to amplify their bets, increasing their risk and exposure. Speculative frenzy in the stock market includes the GameStop saga, Tesla mania, and the S-Pac craze. These sectors and stocks have attracted a lot of attention and money, but they also have a lot of uncertainty and volatility. The notable investor Micheal Burry has taken a bearish stance since the 2024 stock market, yet the exact reasoning or strategy behind this position remains undisclosed. Some potential explanations for Burry's position include a belief that the stock market is currently in a bubble that will burst soon, a protective hedge against a potential downturn or black swan event, or the exploitation of an arbitrage opportunity due to a mispricing or discrepant gap between put options and underlying ETFs. As of yet, however, there is no definitive information on Burry's motivations. These are some of the possible reasons why Micheal Burry is making a massive bet against the 2024 stock market, but they are not the only ones. Burry may have other motives or methods that are not known or disclosed to the public. He may also change his mind or his position at any time, depending on the market conditions and his analysis. Burry is known for being a contrarian and a visionary. He is also known for being a secretive and mysterious figure. He does not reveal his secrets or his sources, and he does not follow the crowd or the consensus. He follows his research and his intuition, and he makes his own decisions. As an investor or a trader, what does Burry's bet mean for you? Should you follow him or ignore him? Should you buy or sell? Should you be scared or excited? Unfortunately, there is no easy answer to these questions, as the stock market is complex and unpredictable, and different investors have different goals and risk profiles. However, there are some possible suggestions or recommendations that you can consider. Firstly, do your own research and due diligence. Don't unthinkingly follow or copy anyone, even if they are famous or successful. Don't rely on rumors or gossip, social media or mainstream media. Don't be influenced by emotions or bias, fear or greed. Instead, do your homework and analysis and make your own informed and rational decisions. Use multiple sources and perspectives and verify the facts and the data. Secondly, diversify your portfolio and hedge your bets. Don't put all your eggs in one basket or one sector or stock. Don't bet everything on one outcome or scenario. Spread your investments across different asset classes, such as stocks, bonds, commodities, currencies, and cryptocurrencies. Use different strategies and techniques, such as value investing, growth investing, momentum investing, and contrarian investing. Balance your portfolio and hedge your bets to reduce your risk and increase your return. Lastly, be flexible and adaptable. Don't be stubborn or dogmatic or stick to one viewpoint or opinion. Don't be afraid or ashamed to change your mind or your position if the situation or evidence changes. Don't be complacent or overconfident or ignore the warning signs or the feedback. Be open and curious and learn from your mistakes and successes. Be agile and responsive and adjust to the changing market conditions and opportunities. Be ready and willing to act or react, to buy or sell, to enter or exit, to hold or fold. These are some of the possible ways to deal with Burry's bet, but they are not the only ones. You may have your own ideas or opinions, or you may have your own questions or doubts. You may agree or disagree with Burry, or you may be neutral or indifferent. You may be bullish or bearish on the stock market, or you may be cautious or optimistic. You may be interested or intrigued by Burry's bet, or you may be bored or annoyed. Thank you for watching. We hope you found this informative and interesting. If you did, like it, share it, and subscribe to our channel. Hit the bell icon to get notified of our latest videos. If you have any comments, leave them in the comments section. We appreciate your feedback and support. Until next time.